What's up, guys? I'm Nobody Special, and interest rates have started 2022 with a bang. Rates on the benchmark U.S. 10-year Treasury are up almost 20 basis points in just the first 3 days of trading of this year, showing that the Fed means business, that this accelerated taper is starting already. The bond market does not like it, and if these rates run too far, too fast, it may be too much for the economy to handle, and we could get that massive market crash that a lot of channels, including this one, have been calling for some time. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. And if you're one of those folks who's been saying that the Fed taper was all talk and that it hasn't really happened, it looks like the bond market is calling your bluff, son, because the Fed is tapering. Boy, are they ever. And look no further than the yield on the benchmark U.S. 10-year Treasury. It is up almost 20 basis points in just the first 3 days of trading of this year. The Fed is not messing around. They are tapering their asset purchases, and the bond market does not like it. Rates are rising fast, and if they rise too far, too fast, they're going to break something like we've seen before. Now, before we get into the numbers, folks, I have to ask, could you please like this video, subscribe to my channel, and don't forget that notification bell. Really helps me out, and I'd be forever in your debt. And now it is that wonderful time where we shrink my big fat melon of a head, and let's get into some of these numbers. And here we go. The U.S. 10-year Treasury currently yielding 1.696%. There it is, 1.705. We were as high today as 1.71. And keep in mind, we started the year at just over 1.5. Here we are looking at a daily chart going back to August. You can see we have broken through this previous resistance level of around 1.68, 1.69. We're now above that. We've failed to break out of this level a couple of times in late 2021. If you zoom back a little further, you can see this level was also resistance in the first half of 2021. Now we're talking about possibly making new highs where it looks like about 1.75 had been the previous high from 2021. So, folks, rates are going higher. Now, why are rates going higher? Because the Fed is slowing down the rate at which they buy these bonds. Keep in mind, bond prices and bond yields are inversely correlated. So the Fed is the single largest customer for these bonds. If they don't buy as many, that is going to cause the demand for these bonds to go down. That means the prices of the bonds is going to go down. Prices and yields are inversely correlated, and therefore the interest rates are going higher. Now, why is this so important to watch? Well, if you have been following this channel for a while, then you are familiar with this chart, and this is the chart to watch for 2022, folks. What we are looking at here, this is the chart of the U.S. 10-year Treasury yield going all the way back to the 1980s. And I have drawn this purple line. This purple line represents the pain tolerance for the United States economy. Every time interest rates cross above this pain tolerance threshold, or every time they touch this threshold, something in the economy breaks. And the reason why this line is sloping down is because for the last 50 years, we have just been accumulating this massive, massive mountain of debt, both public and private, right? Forget the $30 trillion national debt. Throw in there all the car loans, throw in there all the mortgages, the credit card debt, the state, municipal, pension funds, everything. There is just this insatiable appetite for debt in this country. And as that mountain of debt gets bigger, the amount of interest rates we can afford on that principal is going down, down, down. And every time we have crossed over this pain tolerance threshold, something in the market breaks. Right here, 1987, that is Black Monday, the single largest stock market decline in history. When we crossed above that line. The next time we crossed above that line, 1994, the Japanese bond market crash that spread to the United States. The next time after that, 2000, the dot-com bubble bursting. Again, the markets crashed. The next time after that, 2007, the global financial crisis. Again, market mayhem. After that, December of 2018, the very famous Powell pivot, when Powell went from quantitative tightening and raising interest rates to very abruptly lowering interest rates. And a few months later, he started quantitative easing again. And then after that, we had this unfortunate health situation, which continues 2 years later, which brings us to today. And if we zoom in here, we can see interest rates have been rising since the end of 2020. And now we are again approaching this purple line, this tolerance for pain in the economy. And right now, I put that line somewhere around 2.2%. If interest rates on this 10-year treasury cross above this line, something in the market is going to break. I don't know what it's going to be. Is some hedge fund going to go belly up? Is the MOAS and GME and AMC, is that going to trigger? Are the bullion banks going to be exposed as naked short precious metals and cause the market to crash? Who knows? Something will break at that level. It always happens. And remember, we are just getting started with this taper. Right? The Fed has only just begun slowing down their asset purchases. They first started the taper in November, where in November and December they were only tapering by about $15 billion a month. Now they have doubled that pace starting in January to $30 billion a month, and they say they are going to be done, entirely done, pumping money into the system by the end of March, which means this trend that started just at the beginning of this year is going to continue for the next 3 months at least. So we may actually be pushing this line in very short order. The Fed is getting increasingly hawkish in its rhetoric, which means this pace may even accelerate. We could see this line even steepen. We could get to it sooner than March. And I want to draw your attention to this story that just came out today. Federal Reserve puts wheels in motion for balance sheet reduction. Now, keep in mind, we're not talking about a taper here. We're not talking about a rate hike. This is a balance sheet reduction. What a balance sheet reduction is, I need you to think money being destroyed. This is the opposite of QE. This is when the bonds on the Fed's balance sheet mature, the Fed gets paid back that money and they destroy it. Right? If there's any little profits, they send that over to the Treasury. But the actual principal, the money that the Fed printed when they bought the bond, that gets destroyed. So this is quantitative tightening they're talking about. Not slowing down their money printing, not tapering, not rate hikes, quantitative tightening. They've only done that once in recent history, and it did not go very well. Put a pin in that. We'll talk about it in a second. Federal Reserve at its December meeting began plans to start cutting the amount of bonds it's holding, with members saying that a reduction in the balance sheet likely will start sometime after the central bank starts raising interest rates, according to minutes released Wednesday. While officials did not make any determination about when the Fed will start rolling off the nearly $8.3 trillion in treasuries and mortgage-backed securities it's holding, statements out of the meeting indicated that the process could start in 2022, possibly in the next several months. Almost all participants agreed it would likely be appropriate to initiate balance sheet runoff at some point after the first increase in the target range for the Fed funds rate. And that first increase could come as soon as March. So we could see the Fed start rolling off its balance sheet as early as, June of this year. This is a very hawkish shift for the Fed, and this is just the latest in a series of hawkish shifts over the last few months. The Fed is getting increasingly bold in its rhetoric. Folks, these rates are going higher. They're telegraphing it. Market expectations currently are for the Fed to start raising its benchmark interest rate in March, which would mean that the balance sheet reduction could start before the summer. Now here, this is important. The minutes also indicated that once this process begins, the appropriate pace of balance sheet runoff would likely be faster than it was during the previous normalization episode in October of 2017. Now that is an interesting data point, and that could be trouble because the last time we did quantitative tightening, it did not end well. And I want to draw your attention to this chart. This is the Federal Reserve's balance sheet. Think of this as the amount of money printed and the amount of stuff bought by the Fed going all the way back to 2004. Now, you can see here in the run-up to the GFC, things were kind of flat. Boom, the global financial crisis happens. We get TARP, we get QE, all right, and boom, the Fed balance sheet runs up. Then we get QE2 and the taper tantrum, and then QE3. And then right around 2014, things leveled off for a couple of years where the Fed just held. Now, what that means is the Fed was not adding to their balance sheet, but as those bonds and MBSs that were on their balance sheet were maturing, the Fed was just buying new ones with those repaid loans. So the net effect on the balance sheet was unchanged. Now that all changed in 2017 when Jay Powell began his famous quantitative tightening. And you can see that starting here towards the end of 2017. And here we can see the Fed balance sheet actually going down. It's the only period in this chart where the balance sheet actually went down for any significant amount of time. Now the reason why this is so important, because I want to draw your attention to these dates. To 2018, we're winding down the balance sheet. Money is being destroyed. Money is being taken out of the economy. We get to about here, November, December of 2018. That's when we had that big Christmas Eve sell-off in the stock market. That was the famous Powell pivot. Now, they kept quantitative tightening, but Powell started lowering interest rates at this point. Now, the tightening continued even after that market freak out. And again, that market freak out, that was right here. That was when we crossed over this pain tolerance threshold on this chart. But after that market freak out, the quantitative tightening continued for the first half, the first 3 quarters of 2019. And then we got to September 17th, 2019, repo madness. And that was the beginnings of a liquidity crisis in the U.S. banking system. It didn't get a lot of attention at the time, but that scared the crap out of markets. And you will notice if you zoom in here that J-Pow overnight went from quantitative tightening to quantitative easing. And they continued printing money for the ensuing several months right up until the unfortunate health events. And that's when the money printing just went absolutely off the deep end. So take this seriously, what the Fed is talking about doing. Not only have they increased the speed of their taper, not only are they moving up their timetable for rate hikes to include a rate hike possibly as soon as March, now they're talking about this year, maybe as soon as June, starting to roll off their balance sheet. That means they're going to start destroying money very soon. That is going to be a very deflationary event that is going to drive interest rates much higher, much faster. And I just showed you in that chart, if we cross over that pain tolerance threshold, that downward sloping line, which right now puts the maximum sustainable interest rate in the U.S. 10-year Treasury at about 2.2%. If we go above that, something's going to break and the market is going to crash. How do I know that? Because every time that's happened since 1987, the stock market has crashed very soon afterward. So pay attention to those interest rates, folks. Pay attention to that downward sloping line. And if we get anywhere above 2%, anywhere near that 2.2% line, something's going to happen. Guys, I want to thank you for your time. Thank you for watching this video. Don't forget to like this video, subscribe to my channel, and hit that notification bell. It really helps me out. And in the meantime, live small and dream big.